Managerial accounting reports are essential tools that help businesses navigate a complex world of finance and operations. Unlike financial accounting, which is primarily focused on external stakeholders and compliance, managerial accounting is all about internal decision making. It's customizable, it's strategic, and it's crucial for optimizing company performance. So, let's dive into the different types of managerial accounting reports and explore how they can empower business leaders to make informed decisions. First up, we have budget reports, which serve as the financial blueprints for organizations. Imagine planning a road trip. You wouldn't just hop in the car and start driving without a map or a plan, right? Budget reports are that map for businesses. They outline estimated revenues, costs, and allocations for various departments over a specific time frame, be it monthly, quarterly, or annually. These reports set the financial parameters within which a business aims to operate, acting as a navigational tool for both short-term actions and long-term strategy. The importance of budget reports can't be overstated. They guide resource allocation, ensuring that every department has the necessary funding to operate effectively. They also allow for performance monitoring by comparing projected figures with actual results, enabling real-time adjustments. Think of it as having a dashboard that alerts you when you're veering off course. Additionally, these reports help in cash flow management by providing early warnings about potential cash flow problems, helping organizations avoid liquidity crises. And let's not forget about strategic alignment. They ensure that spending aligns with organizational goals and objectives. Now, let's break down the components of budget reports. One key element is the cash flow forecast, which provides an estimated cash inflow and outflow over the budget period. Understanding cash flow is pivotal for maintaining operational solvency. For instance, if a retailer anticipates a significant cash inflow during the holiday season, they might plan debt repayments or capital purchases accordingly. This foresight can make all the difference. Next, we have budget variances, which highlight the differences between projected and actual figures. Positive variances indicate areas where resources can be reallocated, while negative variances signal the need for cost-cutting or strategic adjustments. For example, if a marketing budget was projected at $50,000, but actual spending reached $70,000 without a corresponding increase in customer acquisition, it's a clear signal that marketing strategies need to be revisited. Another crucial component is the capital expenditure budget, which plans for acquiring or maintaining long-term assets, such as machinery or technology. This is vital for long-term planning because these investments can significantly impact a company's growth and competitiveness. For instance, a manufacturing company planning to invest in automation technology would outline costs, expected ROI, and how this aligns with broader growth strategies in its capital expenditure budget. Moving on to performance reports, these serve as an evaluative lens through which organizations assess the efficiency and effectiveness of their operations. Unlike budget reports, which are primarily forward-looking, performance reports analyze actual data, providing a retrospective view that can inform future strategy. The significance of performance reports is manifold. They enable businesses to determine if they are meeting strategic objectives by evaluating key performance indicators in real time. They also help optimize resources by pinpointing underperforming areas, fostering employee accountability, and mitigating risks by identifying potential bottlenecks before they escalate. Now, let's differentiate between traditional and modern performance reports. Traditional reports often focus on financial metrics like revenue and profitability grounded in historical data. They provide insights into what has already occurred but less about what might happen in the future. Common KPIs in traditional reports include return on investment and gross margin. For example, a retail store might analyze how well a holiday sale performed regarding revenue and cost, allowing for a post-mortem event analysis. In contrast, modern performance reports take a more comprehensive approach by incorporating both financial and non-financial metrics. They leverage data analytics, machine learning, and predictive modeling to offer a holistic view that enables proactive decision-making. Elements of modern reports include the balanced scorecard, which incorporates financial and non-financial indicators, real-time analytics for immediate access to performance data, and predictive modeling to forecast future performance based on current and historical data. A SaaS company, for instance, might use modern performance reporting to measure customer churn rates and server downtimes alongside financial metrics, providing insights into product quality and customer service effectiveness. Now let's talk about cost reports, which are specialized documents that dissect a company's expenditures into various categories. These reports analyze direct, indirect, fixed, variable, or even activity-based costs, depending on organizational needs. While budget reports focus on future financial planning, and performance reports assess operational efficiency, cost reports aim to provide a granular understanding of how and where money is spent, Understanding the utility of cost reports hinges on several key factors. They help identify inefficiencies or redundancies that could be eliminated to save money, allowing for cost optimization. They also provide insights into profitability by helping businesses price products or services more accurately. Additionally, detailed cost data can indicate whether certain operations align with a company's strategic objectives. This information forms a foundational layer for informed decision making. Cost reports can vary widely in focus and complexity. Standard cost reports compare standard and actual costs based on historical data, helping identify variances that need addressing. Job cost reports are tailored for project-based businesses, detailing costs for each job, which facilitates more accurate billing and future project estimations. Activity-based cost reports allocate indirect costs to specific activities, providing a nuanced view of expenditure. Finally, variable and fixed cost reports separate costs into variable and fixed categories, aiding in scalability and pricing decisions. Now, while budget, performance, and cost reports form the backbone of managerial accounting, we also have specialized reports that address unique business needs. These reports fill the gaps left by traditional reports, providing targeted insights for specific scenarios or questions. Feasibility studies are one type of specialized report that evaluates the practicality and viability of a proposed project. These studies incorporate elements of cost, market research, technology assessment, and legal compliance to present a well-rounded view of potential risks and benefits. For instance, before entering a new market, companies conduct feasibility studies to assess competition and market demand, ensuring they're making informed decisions. Another type of specialized report is the ad hoc report, which is created for specific, often unanticipated needs. Unlike standard reports that follow a routine schedule, ad hoc reports are generated on demand to address urgent matters. For example, if there's a sudden supply chain disruption, an ad hoc report could assess the financial implications and potential mitigation strategies. Inventory reports are another crucial type of specialized report that focuses specifically on tracking and managing inventory levels. These reports offer real-time data that helps optimize inventory turnover rates and minimize stockouts or overstocks. Types of inventory reports include ABC analysis, which categorizes inventory based on importance, turnover reports that measure how quickly inventory is sold, and aging reports that identify items nearing expiration. In conclusion, managerial accounting reports are indispensable tools that provide organizations with the data and insights they need to make informed decisions. While financial accounting caters to external stakeholders and is constrained by standardized rules, managerial accounting is designed for internal use, offering much-needed flexibility tailored to an organization's unique needs. From budget reports that lay the financial groundwork to performance reports that evaluate operational effectiveness, and from cost reports that scrutinize expenditure to specialized reports like feasibility studies and ad hoc reports, each type serves a critical role in an organization's decision-making matrix. As we navigate an increasingly complex business landscape, mastering the art of managerial accounting reporting is not just beneficial, it's essential for survival and growth. Understanding the different types of reports and their specific applications enables managers to optimize resource allocation, refine strategies, and steer their organizations towards sustained success. In this age where data is the new oil, harnessing the power of managerial accounting is the key to unlocking potential and driving long-term growth. So, whether you're assessing the profitability of a project or contemplating a new market entry, remember that these reports provide the analytical rigor required for effective strategic planning.